All right, so how do you avoid taxes on your retirement income? Now, there's a lot of different retirement plans out there. Most of them, the most popular ones, actually do tax you in retirement. But there are some that are tax-free that you could actually be using right now. And even better, some of these things will actually allow you to retire before retirement age and still have tax benefits too. So let's dive into what those are right now. Okay, so let's understand most of the retirement plans that are out there. Most people are either investing in IRAs or 401ks, right? If you work a job, you've been told by your employer that this is the plan to do. You should be doing the 401k. It's going to be amazing. I actually remember that with the very first corporate job that I ever had, when you hit your 6-month mark, you're now at the point where you can actually contribute to a 401k plan. I go in and sit in this conference room with all these other workers, and then the benefits specialist from HR, this woman that was probably no older than about 30, 35 years old, comes in and she says, here's the 401k plan. It's great. You can put your money in and you get a tax write-off. And then when you're able to take it out later in retirement, yeah, you get taxed on it, but it's okay because when you're old, you really don't spend money. You know, you'll have a paid off house, your kids will be gone, and so you're really doing anything. So for you, you don't even need to worry about taxes. And I'm looking at everybody else like, did you just hear this? Did she just say that people when they get older don't do anything? But that's what she was assuming, right? Now, I knew that wasn't true, but I thought I'll try this 401k plan out. But here's the problem with the 401k. Besides the fact that most 401k funds, the things you invest in, don't even get the same returns as the stock market. They're way worse than what the stock market returns are, which is why even if you get the match from your employer, it really only just makes up for bad mutual funds that you're investing in anyways, so that you make maybe average returns normally. But beyond that, the thing is, yes, you put in pre-tax dollars, so you don't get taxed on that money. You really don't get a tax write-off. You get an income delay. You delay your income till a future date. So when you do pull that money out, which is got to be after 59 and a half, otherwise they slap you with a 10% penalty and then they tax you too. But when you pull out 59 and a half or older, they're going to throw on these ordinary income taxes, which is the highest tax brackets you can be in. Ordinary income tax is the one that you get no real tax advantage. But remember, because you didn't get taxed in the beginning, you get taxed at the end. Now this is where people will make an argument for Roth IRAs. Roth IRAs, you don't get the tax advantage up front. You use after-tax dollars, like the money you get after you get paid your paychecks. You use that money. That money goes in, gross tax-free, comes out tax-free. Now, there are also rules like 59 and a half, you're supposed to be waiting until at least that point, or at least until you start pulling out the gains from it. You can pull out the money you put in earlier without any penalties, but just be aware that there are certain rules you got to follow there too. But that's a great one, especially if you're going to retire in your 60s, because you can have tax-free retirement income. The only thing is that a lot of people run into this block, or this obstacle, I would say, because they look at the Roth IRA and then they say, well, I can only put in $7,000 a year. That's not going to add up to much in the future. I'd have to save for a couple lifetimes to make that worth something. And they're right. Saving $7,000 a year, that's great. It's really, and by the way, if you make too much income, depending if you're single or married, if you're making at least $150,000 or $200,000 a year of income, you don't even qualify to save in a Roth IRA. Technically, I don't qualify unless I do what's called a backdoor Roth IRA, where I have to set up an IRA and I have to go and convert it to a Roth every year, and then that money, I have to get taxed on it anyways. So I'm like, okay, I just had to pay a big tax bill after putting in this money to then be a Roth and pull it back out again. And I'm like, well, that was like a bunch of runaround. Just try to get money into a Roth IRA. You could do a Roth 401k. There are options like that. That's better. But again, remember, there's still rules. And also, if you work for an employer and you have money in a company type of plan, one thing you got to understand too is that money is locked up. You cannot access that money. You can borrow from it up to a certain point, but it's not a lot. Yes, you might be able to use it for a first home. You can maybe use it for your college if you're going to college at the same time. Only a certain limited amount there too. But really, you can't access that money very well. You have to either quit jobs, change jobs, get fired. Something has to happen for you to be able to access that money when you need it. So it's not a good emergency fund, not a good place to store all your money if you don't have savings at home too. Also, here's another thing too, is that most people don't realize that the 401k plan, and this is technically true even with an IRA, most people don't realize they don't own their 401k plan. Now, I've had people even on here on YouTube try to blast me for this. They're like, no, 401k, I own it. I know the 401k is a sacred cow. You don't want to get rid of it because you love it so much. It's like your little baby. Your kids you ignore, but you love your 401k, right? Well, the problem with it is this, is that if you look at the actual rules, the IRS is the one that set up this plan for you. By the way, did you know a 401k was actually created for high paying executives initially in the 1970s because the tax rates were as high as 80%, but because financial companies loved the business they were getting. If people could do it all people would be able to contribute to it, then they can make more money. The government also liked it too because that meant less people rely on Social Security. They decided to open up for everyone, even though it didn't make sense from a tax standpoint. But that being regarded, you'll also notice too is that the actual federal government, the IRS, is actually the owner and controller of your 401k. So your 401k is not owned by you. It might say for the benefit of, and then your name is filled in that blank there, but it's only for your benefit, but they're the ones that own and control it, which is why they can change the rules. Right now it's 59 and a half. What if they decide to change it to be age 62 and a half? You have to just go with it. You can't just say, wait, but you told me this. Doesn't matter. It's like having a business partner that can make up all the rules, tell you how much you can get paid, when you can get paid, even how much money you can pull out, even though you're the one working and putting all the effort into that business. Still, they're the ones that tell you what you can do with your money. That's exactly what a 401k plan is, and it's just the same with an IRA. Now, Roth is a little bit different. It was made by Congress, not by the IRS, but even then, you got to understand that they could change the rules too at some point. But I will tell you this, a Roth IRA could be much better because if you want tax-free retirement income, you put in with after-tax dollars, gross tax-free comes out tax-free. Just make sure you play within the rules that, again, the government gave you to impose upon you to say you got to make sure you follow these rules. But that could be a much better option if I were to give my own opinion on that. Now, like I said, there's Roth 401ks that will allow some tax-free withdrawals in the future. But what else could you be doing that could be tax-free? Another option that now has become more and more popular, especially recently, has been using life insurance. Now, this has been tax-free for many, many, many years, like well over 100 years. This has been in effect, right? The money is just like a Roth IRA. You put in with after-tax dollars, gross tax-free, comes out tax-free. The good news, however, is that there is no age rule here. Unlike 401ks where you have to pull it out by age 72 or not pull it out before 59 and a half, or they slap you with a 10% penalty, there aren't those rules with life insurance. If you want to pull that money out in your 20s, you can do it. Your 30s, 40s, 50s, doesn't matter. You can access that money, and again, that money's tax-free. Now, you got to make sure you pull out certain ways too to make sure it stays tax-free forever. But that's the beauty of it, is that you put in with after-tax dollars, gross tax-free, comes out tax-free. Even the death benefit to your family is tax-free. The only thing though, I think is even better, is that also my money is protected from lawsuits and creditors. In most states, it's 100% protected. Also, if I'm trying to qualify for student loans or for financial aid or getting scholarships for my kids in college, the money I have in the policies do not count as an asset. So it doesn't count when I don't want it to count, but it does count when I need it to count. If I want to go get a mortgage or a loan, I just show them my statement for my life insurance because it's not just a death benefit, it's got this tax-free savings account inside of it that grows tax-free. Right now earning roughly about 6% a year tax-free. Way better than a high yield savings account, and I don't have to worry about getting taxed like the high yield savings account gets taxed. So the cool thing is that that money is there, and of course if I want to go get a loan or something like that, I just show them the statement of my life insurance. They say, good, check, you got your cash reserves, moving on. And they pull credit and they do all that other kind of stuff, right? So I can actually use it for multiple purposes now, not just for when I retire. And the cool thing is, like I mentioned, when you do pull that money out, it is tax-free retirement income. Give you an example. I had one client that said, you know, Chris, I want to retire in my 30s. So he's like, here's my game plan. Now he already had some rentals and things that were paying him cash flow. He was taking all that extra money and the money he was saving, rather than putting it into a 401k plan, he was taking that money and buying at least 1 or 2 rental properties every year. He says, Chris, even if I just buy even 2 rental properties a year after these next few years, I do this through the year 2029. Yes, it depends on the cash flow, of course, but it can vary. But right here, I'm projecting over $4,000 a month. And I said, well, that's cool, but you just told me your goal was $5,000 a month. He said, well, yeah, remember you set up that life insurance policy on me. So he's like, after just the 8th or 9th year, I'm going to start pulling out $900 a month from that it's tax-free income. And I thought, well, that's pretty genius. I forgot to even mention that. Because again, most people will talk about, insurance agents will talk about the long-term, you can use it as retirement, supplemental retirement income. I usually tell people how to use it to invest now to make more money in their investments. But I thought, well, that's a good thing. He's just investing in real estate and he's got that. And by the way, the real estate, because you can depreciate, the properties, you actually get tax write-offs on the money that's coming in. So even though you're earning rental income from those properties, it's coming in with some tax advantages. You pay little to no tax. Plus, if you take that retirement income from your life insurance, like what he's doing, he's paying no tax on that. He can essentially pay little to no tax, and he doesn't have to wait till he's in his 60s. He can do that in his 30s. which, by the way, that's a lot of the things I've done. Now, I don't necessarily pull income out of my life insurance. I'm not worried about doing that now. But it is kind of nice to know that I always have that option to be able to pull that money out. But there are other investment options that are outside 401ks or IRAs. Now, let's talk about if you have an IRA. Let's say we go with the Roth IRA, which we know is tax-free, right? We're trying to avoid tax. Well, did you know that your Roth IRA does not have to be in a company 401k, and it doesn't even have to be in mutual funds? You can actually change your Roth IRA to a self-directed Roth IRA, and then you can choose wherever you invest that money. So yes, you can go and invest in the kind of strategies we talk about on this Money Ripples channel. Things like lending your money out to real estate investors. Wherever you're getting paid 10, 11, 12% a year, guess what? That comes as tax-free income if it's inside the Roth IRA. Now, if it's in a Roth, yes, you do have to wait till you're 59 and a half before you can access those funds tax-free. But isn't it nice to know that, of course, you can create tax-free income from that in retirement? Now, some of my clients will have maybe a little bit there, but then they'll have their life insurance that if they want to bridge the gap, saying, well, I know I have to wait till about 60 for this Roth IRA, but I want to retire at 50. Well, now they got 10 years. What if they use their life insurance as the tax-free income they take now? And yes, what if they even use that money instead of just keeping the life insurance? What if they used it to go buy certain types of real estate assets that do have some tax advantages? By the way, there's even like oil and gas investments that sometimes can give you tax advantages too. Now, are they tax-free? No. But part of the income that you get can be tax-free, so you get some tax advantages with that. You get a reduction of taxes in doing oil and gas investments. Real estate, though, you're going to get more tax advantages, especially if there's things like depreciation on those properties. So now, if you have other types of real estate where they don't have the depreciation, great. If you have a Roth IRA, invest your Roth IRA in the thing that doesn't have tax breaks, and then you can turn something that would normally be taxed into tax-free. The one thing I would not use the Roth IRA for is buying a rental property, because then I lose my tax benefits of the rental if I do that. So that's one thing that is different there. So anyways, I can go on and on about different ways to create tax-free income. Here's the truth. If you want to learn more about how to do that, whether it's about the infinite banking, whether it's about passive income, just go to moneyripples.com. You can go down that rabbit hole there and learn more about how these strategies actually work. Do that right now.